Hello and welcome back to this ESG mini-series where we are zooming in on each one of the three letters. Today we're going to do a deep dive into S as in social. My name is Hanna and I'm a part of the investor relations team here at East Capital. And with me today I have Nissan and Eglé Fredriksson. Nissan is an analyst within the investment team here at East Capital, and he's been working with equity research for almost 5 years, focusing on sustainability, ESG and impact analysis. Eglé has been with the company for 18 years. She's a portfolio manager focusing on Central European markets, and she has a thorough experience of engaging with companies. Welcome to you both as well.
Thank you, Hanna, for having me.
When we released our ESG outlook back in January, we have highlighted people as one of the dimensions that we believe will shape the world of ESG investing going forward. And this transformation was very much speeded up by the ongoing pandemic. Paul, in the invitation, we have said social equal people, but if we are going to be a little bit more formal here, is there a standard definition of what goes into the letter S?
Fantastic question, Hanna. And I'm more than happy to talk about the social aspect in ESG. And I mean, we could really attack this in many different ways, but I think I would like to direct the discussion towards the social taxonomy and also take the opportunity to discuss gender diversity, as I think it should be a natural discussion in occasions like these. And environmental and social aspects are parts of the EU Sustainable Finance Strategy, as you may be aware of. It is widely recognized that there is a need for social investments to both achieve these Sustainable Development Goals, the SDGs you might have heard of, which is the United Nations 2030 Agenda, and also create the social internal market set out in the European Union. And here it is also widely recognized that businesses must show respect for human rights, aligned with the UN guiding principles. And the EU platform on sustainable finance, they published its report on the social taxonomy in February this year, and the Commission will assess if taxonomy should be extended by July 22. And the format of the social taxonomy is quite similar to the ones you have seen in the environmental taxonomy for those who are familiar with that framework. And you're looking at the development of 3 social objectives, types of substantial contributions, this do no significant harm criteria, and minimum social safeguards. The suggested social taxonomy, when looking at the objectives, it contains 3 objectives, each addressing a different group of stakeholders. You're looking at the own workforce, end users, and affected communities. So you go a bit down the road, so to speak. And those goals are decent work, adequate living standards and well-being for end users, and inclusive and sustainable communities and societies. And of course, you said earlier you spoke a bit about SDGs, or I think we'll come into that at the later stage. But some of you, when I just explain to you what those goals are about, then you will pretty much be able to link those to a lot of the United Nations SDGs, which we work quite a lot with. And just another final comment on the social taxonomy, I think it will create so much more publicly available information. And my experience is that sustainability transparency by companies has increased looking back 3 to 4 years down the road. The information put into integrated annual reports with the sustainability part, but also single sustainability reports, information has increased, but also the materiality. So the decision useful information has increased, and I think it will continue to do so over the course or going forward as well.
Paul, you mentioned gender diversity earlier on, a topic which I think is very important. Can you maybe develop that a little bit more?
Right, I'm happy to do so, Hanna. So, I mean, if I would give you 4 findings from the Global Gender Gap Report published last year by the World Economic Forum, 1, it will take 136 years to close the gender gap worldwide. The gender gap in political empowerment is the largest gap tracked with only 22% closed to date. The third is that the gender gap in economic participation and opportunity is the second largest of the 4 key gaps. and it is really estimated to take around 268 years to close this gap with current trajectory. This means that my kids, my grandkids, and my great grandkids won't even see this parity over their lifetime. So it's just nonsense. And also, maybe the fourth topic, I think that the report also highlighted was that COVID had an effect on gender gaps in economic participation, where women lost their jobs to a greater extent than men. So just taking this into context, when analyzing and engaging with companies, I think it's very crucial to understand not just their policies and practices in place, but just, we need to scratch on the surface and really question what we see at first sight. What are the internal goals split on board and key executive level alongside total workforce, and are those based in class? Just because they have a goal doesn't mean they're good or doing a great job. And also, the numbers, are those communicated to investors with a year-over-year comparison provided to track progress? Not all the time, and we should really be able to push for this. And really, I mean, the evidence is just it's all over the place. We lose billions and trillions of dollars due to gender and racial biases. And there's a lot of market studies conducted that you will achieve a greater EBIT margins, return on assets, and lower cost of capital. And I think we need to work with a sense of urgency. I mean, it could be Ursula Leyen pushing for 40% women quota on EU company boards, but at the end of the day, I think it's a team effort, and there's a lot of things to be done, especially among us asset managers in particular.
Well, the numbers you are mentioning is absolutely mind-blowing, and it's very kind of sad to see how much is still to be done here. Social is often mentioned as one of the most difficult aspects when it comes to integrating ESG into investing. But on the other hand, the majority of the sustainability development goals defined by the UN are actually linked to the S. So can we maybe talk a little bit about, why that is, what's the difficulties with the measurements, etc. Eglé, do you want to comment on that?
Yeah, of course, Hanna. I mean, as you mentioned, just the magnitude of these problems just highlight that this social aspects probably have been a bit trailing the other sort of governance and environmental issues, and should be very rapidly moving up the agenda of investors' concerns when they analyze ESG. And especially the regulation that Paul mentioned, that will be sort of strictening so fast, and it's not without a reason, because of course there are difficulties how to address, like especially super long supply chains that globalization has produced in our world. I mean, globalization is a great thing, but how to control for the child labor, unfair wages, or unsafe working conditions. But just a pure sort of unionization or the labor rights, even in a closer proximity markets. So gender pay gap is a problem in absolutely every company. So I think the way we look at it from East Capital investment policy point of view, from ESG analysis point of view, we completely try to avoid tick the box. I mean, we really don't want to see any sort of policies and sort of issues solved. The policy doesn't solve any issues. We want to see clear metric targets. We want to see companies really understanding the issues, the problems, and just also seeing how it works. So once you understand, how do you approach it? How do you try to reduce these risks? And as I said, clear metric targets is one of them. What you cannot measure, you cannot improve. Also, how maybe a bit moving towards the entire approach. I mean, it's always very, very, very important to understand corporate culture. And this comes also from East Capital way of working, know your owner. It's for all the letters, but for social in specific, is workers one of the main assets, or the main asset that the companies have, and is that sort of an intention of the main owner to develop that asset. And then I can speak a bit more concrete things that we are doing then.
Maybe Hanna, just add to the comment Eglé already comment and just some side notes to that. And I think it gets more complicated when information is not standardized. That's one thing, and also equally provided by each company depending on what jurisdiction you're in and which sector you operate in. And certain sectors and industries are subject to greater probability of social controversies or risks and opportunities. And this is where you should focus your attention on. You should be very careful with not just industry and sector specific risk, but also company specific risk. Just because it's widely used for the sector, you need to be diligent with each and every firm you're focusing on. And I think we are approaching a standardization with a certain degree of variation, depending on sector and company specific risks. We see different, frameworks, SASB, and also what the European Union is now trying to do. They're trying to unify information and ensure that information flow is much greater and stronger. But just looking at what we are looking at when we're considering companies in our portfolio, in our analysis, we're looking at social issues due to regulatory or fundamental aspects that may affect the company's cash flow, balance sheet, short to mid-term, workers' right to join unions and collective bargaining agreements, social scandals, supply chain programs, its code of conduct, health and safety systems. And these are all in those frameworks. And I mean, we're not doing it just because the frameworks are telling us to do it. We have done it before. So I think it's just showing our diligent job with this social aspect. But of course, I think we have a lot more to do, and I'm more than happy to be part of that journey.
That's great to hear, Paul. Those listening to the webinar we did on and deforestation heard Rosemary mentioning that deforestation isn't only about the environment, it's also very much about the people who are being affected by this. And there is often an interconnection between the different ESG metrics. You've mentioned that as well, Eglé, today now. But Paul, can you maybe add to that as well, how we work in that regards?
Sure, and I think Rosemary, she's always bringing good content to the table. I mean, she's a fantastic colleague and a friend of ours. But many times environmental, social, and governance opportunities and risk, for that sake, they are interlinked, and they very seldom go alone. So social issues, they are interlinked with environmental and governance aspects, which is why doing a full-fledged analysis is more insightful rather than just getting a recap of the top 3 sustainability issues of a firm. When you're doing an analysis, you're flipping back and forth from the governance section to the social section to the environmental section, and once you're done with analysis, it is at that point the most of the company, and that's when you can really iterate and change, and you see all the interlinks here. For example, health and safety issues in metals and mining is material, and having a 0 fatality target is something you would expect. Also linking such targets to the management incentive scheme is relevant. Same thing could be done with environmental metrics such as greenhouse gas intensity metrics and so forth. Really linking governance aspect with social, you need to really know where the material risks and opportunities are in a company. So getting to know the company's specific material risk and opportunities, and also getting a clear understanding of how they manage those risks is super important, and you won't achieve that just by scratching on the surface. I think the assessment should be done and focused on magnitude rather than a binary assessment. So just checking the box or reading a policy, I don't think that's enough. And I would argue that there are not always enough publicly available information out there to get a full understanding of a certain question. Then it's your responsibility as an investor to get get an understanding of this question. Contacting the company, speaking with whatever contact you might have, IR or CFO or CEO, sometimes even the board members of the firm. We need to ensure that we understand and always cover those black holes, I think.
Yes, and Eglé, in your role as a portfolio manager here at East Capital, can you maybe talk us through a little bit of how you address the social risks in practice, if you have examples of how you have worked with companies to impact and make a change here, that'd be very interesting.
Maybe I'll talk a bit again about a more challenging sectors of companies, because what Paul mentioned, of course, this transparency is increasing, but what sadly it's increasing on just a company level, where you have industries like, for example, fashion or the footwear, but that have supply chains that are producing over like 90% of the value added in that product. So you basically see just less than 10% of the value chain if you just look at the company. So what we really need to know what is happening in the supply chain, and that transparency is unfortunately still very low, and this is what we really want to make an impact, especially for the companies that maybe are themselves still on a learning curve. So as I mentioned, like we have an example of the fashion and footwear company. When we started looking at them, their sort of ambition on the supply chain transparency has been quite low, with sort of small improvements of, you know, signing the supply chain, sort of suppliers saying, or having no audit once they signed in. I really don't know what is the situation after they have been signing. There's no audit, no results published after the audit. So the transparency is actually very low. And when we sort of attacked that, we kind of contacted the company in different ways, in the sort of meetings and letters, and we wanted to have a holistic approach, how they will increase this transparency and especially improvement of the supply chain. After a few months of discussions, I mean, when the company have been publishing their later sustainability strategy, we see the completely different attitude and the ambition of the sort of way they approach supply chain. They are sort of committing to cover with audits all the high-risk suppliers. They are committing to have all the suppliers signing their code of conduct. They are committing to publish the results of the supply chain audits. They are even committing to the second-tier audits to fill the reports of violations, because this industry doesn't even have like one layer. I mean, you have suppliers sort of providing you with the garments, but there are also raw material suppliers, there are chemical suppliers, there are sort of processing companies, and these sort of 3-4 tier chains in the value added are very sort of complicated to address for the investors. And here, I mean, the standardization reporting, unfortunately, that will have to be improved substantially for us to have a better picture what is happening, and they have to be very strict with their suppliers in this. And I think when it happens from many different directions towards the sort of supply chain, it will start improving. And we at this moment we see sort of at least the understanding of the corporates improving quite well, and with these also long-standing engagements that we have, we see the genuine sort of interest of the companies to change, to commit to these sort of transparency improvements. And also we see that they not only go for those improvements that we are asking, but they stepping even further. For example, this company was having quite bad numbers on their gender pay gap, with a sort of commitment to improve it just by 2%. This is a huge issue. So when we spoke to them, by 2030, they committed to 0% of gender gap. That's better than what we heard from Paul. And also the other things like a glass ceiling ratio. This is how much women are able to reach management levels. So we see quite good improvement in the companies' understanding of social risks, and hopefully, you know, they will be better prepared for the upcoming regulation, because I think that will be pushing the rest of the pack. Unfortunately, some of them probably will face reputational and financial consequences, because that has to start to happen at some point. This was, for example, the engagement that we were solely as is capital engaged, but sometimes we do engagements together, collaborative ones with other investors. There was a European company, a very large listed company, that together with other asset managers representing over 350 billion euros altogether, we had a collaborative engagement to improve the labor rights of the people there, the rights for unionization, and it was done in a sort of friendly manner, sending letters, but yeah, having meetings and discussing these issues, asking for more information. But of course, you know, if company doesn't do anything, we are prepared to escalate and to make these questions public, publish the excerpts of these engagements, and address the issues in the company's AGM. So these are sort of examples how to basically address these issues. And at some point, we still believe that divestment is not a solution. We really have to be long-term. We have to improve the understanding of the companies and push them to improve.
I think it's interesting you're mentioning, you know, a few things that is actually going to drive the change, and governments and new regulations. But it sounds like the dialogue and actually learning curve is the key thing here, to help them understand why it is important and why it's actually in the end should benefit the companies themselves as well. Very, very helpful. If I can ask you maybe as a final point today, if we would try to look into the future, like let's say 5 years from now, are there any aspects of the S that you think have come quite a bit by then? And are there other aspects that you're more concerned about that is lagging behind?
Well, I still believe, you know, in the aspects that are more quantifiable and more measurable. In this way, may be addressable through regulation, there will be more progress. There will be, of course, less progress in things that are difficult to define. I mean, we have indirect aspects of social issues, such as sort of children's well-being when their parents, you know, are working and not seeing those children for several years. How do you quantify that? How do you address that? The sort of bonds lost between children and their parents, but things like gender gap, things like I mean, more quantifiable health and safety incidents, those things I think will really be, you know, some of the top of agenda. We all understood how, and COVID-19 also showed how fragile is actually human life, how valuable are workers to the businesses. So I think these issues will definitely come up and be much more of a focus in future agendas of corporations and investors.
Thank you, Eglé. Paul, do you have something else in mind that you want to add?
Right. I mean, I think Eglé, she's brilliant. She covered a lot of topics, and she also mentioned that, you know, children not able to see their parents because they work too much, and, you know, also the other way around, like child labor, for example. I think the lower bar will be increased, as well as the higher bar will increase due to transparency. So really, like, what investors, us as owning the problems, owning parts of the profits, I mean, we're part of it. We need to really, you know, foster the market, foster our companies to really push the bar higher. And it's really up to us. And as long as we just accept the fact that things are done the way they are now, then this will continue. Of course, regulation will help this journey and just boost it really. So even though this whole SFDR, Sustainable Finance Disclosure Regulation, Taxonomy Regulation, from an environmental perspective, from a social perspective, it's very blurry how you should interpret it, how you should incorporate it. Disclosure burden is put on asset managers first before companies are supposed to disclose. I mean, there's a lot of uncertainty going on now, but I think this change is needed for the greater future. So I'm positive, and I'm happy to really work on this. And also, just as a note on that, it's really about when we're working with different initiatives and different investors. I think I just want to make a comment here that the PRI, they recently launched a new stewardship initiative where institutional investors will and can work together to take action on human rights and social issues. And us as investors will use our influence with companies to drive positive outcomes for workers, communities, and society. And East Capital just applied to join this initiative. And I would encourage our dear branch colleagues as well to really be part of this commitment and really push for this S agenda in this environmental history.
Thank you. I think that was a great way to wrap up this webinar. It sounds like there's still a lot to be done. But on the same hand, companies start talking about this more, we start talking about it more, and that will ultimately lead to positive change. If you would like to talk more to me or one of my colleagues about this, feel free to reach out. And I would like to thank Paul and Eglé for joining me today. It's been extremely interesting and very helpful that you're sharing this level of insight of how you're working. And thank you everyone who's been listening in today. I hope you've enjoyed it as well, and I hope to see you soon again.
Thank you, Hanna, for organizing this.
Thank you, Hanna.